Hey everyone, the efficient market theory has cracks, just like my grandma's old china. Markets have anomalies or inefficiencies, which are trading opportunities for us. It's worth looking at my previous video, part 1, if you want more details. In this session, we'll reveal the secrets of behavioral trading to identify and capitalize on market inefficiencies. Subscribe and like for more about this topic. In part 1 of this video, available on my channel, we concluded that theory suggests that neither technical analysis nor fundamental analysis, which relies on publicly available information, can consistently yield superior returns. However, we will cover whether technical and fundamental analysis actually work in another episode. We also conclude that we should just buy the stock index, focus on long-term growth, and keep saving there. On average, the returns will go up and up on a yearly basis. It's like planting a money tree, except that it actually works. Other strategies for semi-strong markets include exploiting surprises in post-earning announcements and targeting firms from merging and acquisitions. It is also possible to research undervalued assets with signs of misinterpretation and get insider intel from companies. In the weak form of efficient market theory or markets, certain behavioral and seasonal patterns such as momentum and calendar effects might still exist. Increasing number of investments analysts are using technical models to track share cycles. In the graph, I use Walmart with Heikin Ashi graph to denote momentum versus retail sales to denote cyclicality. During the dot-com bubble of the late 1990s, many investors overestimated the ability to pick winning tech stocks, leading to excessive trading and inflated stock prices. Does this sound like something familiar to you? Maybe the artificial intelligence hype? Anyway, investors can counteract overconfidence by setting strict rules for trading and sticking to a long-term investment strategy rather than frequently trading based on short-term predictions. Look, for instance, at the paper from Barba and Odin, Boys Will Be Boys, Gender, Overconfidence, and Common Stock Investment. The housing bubble leading to 2008 financial crisis saw many investors buying real estate, driving prices to unsustainable levels. Independent research and contrarian investing can be effective strategies. Look for opportunities where market sentiment is overly pessimistic or optimistic. Remember, just because everybody is jumping off a cliff doesn't mean you should too. Look at Bishandani Sharma 2001, herd behavior in financial markets. In loss aversion effect, investors might sell stocks during a market dip out of fear of further losses, as seen in the rapid sell-offs during the COVID-19 pandemic's early days. Remember the toilet paper rush? Yeah, it's kind of like that. If the drop is in your long-run index, wouldn't that be the best opportunity to keep buying? One can also develop a disciplined investment approach for short-term plays or investments that include predefined loss limits and stick to rational analysis. Don't let emotions drive your decisions. Look for more information about this in Tversky 1979 Prospect Theory and Analysis of Decision Under Risk. Mental accounting is treating a bonus as fun money and investing it in high-risk assets rather than integrating it into an overall investment strategy. No, your portfolio isn't Vegas. Do not allow yourself to treat fun investments or casino money differently in your portfolio. You can create a black hole that eats your money, time, and affects your emotions. Consolidate all financial resources into a comprehensive plan, treating each dollar or pound equally in terms of its potential for growth. Look at Thaler 1999 Mental Accounting Matters. Availability Heuristic is following high-profile stock tips from media without conducting personal research. leading to hare-like buying behavior. Choose well and diversify your information sources. Perform independent research, thorough research, before making investment decisions. Be your own financial detective. See Tversky and Kahneman Availability, a heuristic for judging frequency and probability. Ignoring negative news about a favorite stock leads to continued investment in a declining asset. Just because you love it, it doesn't mean it loves you back. Actively seeking out for and consider information that contradicts your own beliefs. Make more balanced decisions. Don't let your investments become an echo chamber. Look at this in confirmation bias, a phenomenon in many guises, from Nickerson, 1998. Investors might anchor to a stock historical high price and refuse to sell it at a lower price, even when the market conditions suggest they should. It's like holding onto that old baseball card, hoping it will be worth millions someday. To avoid anchoring, regularly review investment decisions against a broad set of information and avoid fixating on specific price points. Keep a flexible mindset. Your portfolio will thank you. Look at Judgment Under Uncertainty, Heuristics and Biases from Tversky, 1974. All right, folks, we've reached the end of our journey through the wild world of market anomalies and biases. Let's quickly recap the 7 deadly sins of investing that we covered today. Number one, overconfidence bias. Thinking you are the next Warren Buffett just because you made a few good trades? Remember, even a broken clock is right twice a day. Number 2, herd behavior. Just because everyone's buying toilet paper doesn't mean you should too. Number 3, loss aversion. Don't let the fear of red numbers turn you into a chicken. 4, mental accounting. Your portfolio is not Las Vegas. Number 5, availability accounting. Don't let the headlines be your financial GPS. 6, confirmation bias. If your investments become an echo chamber, you only hear what you want to hear. Number 7, anchor effect. Holding onto that old baseball card, hoping it will be worth millions someday. Same thing. So there you have it. 7 key biases or deadly sins and ways we can improve that can turn your investment strategy into a sitcom. Remember, the market is unpredictable, but your behavior doesn't have to be. Stay rational, do your research, and don't let these biases steer your financial ship. Thank you for joining me today. Remember, subscribe and like, and happy ending. I mean investing.